are expecting that the Reserve Bank will make an announcement on whether it will hike or hold interest rates this afternoon after the first MPC meeting of the year. This forecast by economists is based on the country's inflation remaining above the central bank's target range of between 3 to 6%. The latest data from Stats SA reveals that consumer price inflation eased to 7.2% in December. That's down from the 7.4% recorded a month before. So what does this all mean, especially for you and I? Well, Dr. Roelof Botha is an economic advisor to the Optimum Group. Thank you very much, Doc, for availing yourself this afternoon. In an opinion piece you wrote, you note that the Reserve Bank is obsessed with inflation targeting and ignorance over the causes of higher inflation during 2022. Meaning what?
Well, the main reason why global inflation spiked last year was because of the lagged effect of the lockdown restrictions and the supply chain disruptions. And just to give the viewers an indication, your Statista Freight Rate Index increased from $1,200 per 40-foot container in September 2019 to $1,200 to $10,000, almost $400 a container 2 years later. That's an increase of 721%. Now, it begs the question, how will a higher prime rate in South Africa, which takes money, disposable income out of South Africans' pockets if they have bonds and credit, how will that solve the world shipping freight cost problem? It's not necessarily the oil price. It's getting the oil from Jeddah to Cape Town Harbour. That was the problem. And I just want to inform the viewers that the root cause of what is happening there with interest rates, because they've raised the cost of credit based on prime by 50%, which is costing South African households and businesses 13 billion rand, with a B, 13 billion rand per month in additional interest rate charges. But this inflation target obsession of theirs, so inflation target is 3 to 6%. Why? Why? When Crystals implemented inflation targeting for the first time decades ago, it was made very clear, this is not cast in concrete. And depending on the economic circumstances, you can adjust those targets. All the Reserve Bank needed to do was to adjust that target temporarily to 5 to 8%. And then inflation, which is already peaked, would have been in that target, and it would not have been necessary to raise interest rates in South Africa.
You also note that in the case of South Africa, restrictive monetary policy has a number of additional dimensions, all of which demonstrate an uninformed approach to dealing with higher inflation.
Yes, I mean, the only type of inflation where monetary policy is effective is demand inflation. If there are too many people wanting to buy too few goods, we do not have that problem in South Africa. And it's as if they're just busy with a copy and paste exercise for what happens in the United States. But the United States has full employment. If you bring into consideration your natural rate of unemployment, which exists in every country, people on sabbatical, people couples that have just had babies that are taking time off from work. If you take the national rate of unemployment into consideration, the US has full employment. I don't have to tell the viewers that we do not have full employment in this country. And the Reserve Bank's mission states very clearly, yes, they must try to combat inflation to the extent that they can, but they must also keep an eye on growth. They are ignoring the job creation and the growth part of their mission.
Doc, you also note a third indictment of the bank's interest rate policy is that the total household credit extension has not remotely recovered from the effects of the extremely high real interest rates from before the COVID-19 pandemic. You also note that our economy has never been able to grow at sustainably high rates in the absence of a meaningful growth in private sector credit extension. What does that mean?
Well, it's quite simple, actually. I think most viewers will realize that if their credit lines get cut off, if you want to buy a house and the bank doesn't want to give you a mortgage bond, there is no consumption expenditure or capital expenditure in this case. So quite frankly, credit makes it possible for people to be able to get involved in consumption expenditure, and that's the main driver of the economies of all the countries in the world, quite frankly. Obviously, one needs to be able to service your debt. The higher the interest rates are, the more difficult that becomes. It's as easy as that. We also see that in house prices. Authoritative indices of house price growth in the last year very clearly, the value of our properties are declining. And of course, household debt servicing costs as a percentage of their income has increased in the third quarter year on year by more than 6%. So the Reserve Bank is not doing this economy any favors because of this obsession with driving inflation down based on an inflation target, which is a dubious theory in the first place, quite frankly. I wish they would, just follow a more growth-oriented policy, and it's very easy to do, and they have the instrument at hand. Lower the interest rates. It's as easy as that.
Lower the interest rates. So you also mentioned that the country's millions of unemployed and marginalized people are the ones that suffer most when an unwarranted obsession with rigid inflation targeting is allowed to override the critically important policy objectives of growth and unemployment creation. The latest statistics from Statistics South Africa on the consumer price inflation notes that food is 12.4% more expensive than a year ago, and non-alcoholic drinks 9.7% more expensive. So touching on the impact on the everyday person.
Yes, absolutely. Inflation is bad. Nobody likes high inflation because if inflation increases, by definition, you also have less disposable income. At that point in time, and until such time as you work a little bit harder or try to find additional sources of revenue, of course. And the point I'm trying to make is that we need to ask ourselves, will higher interest rates bring down food prices? The answer is no. If you look at what is happening to major poultry producers in this country, because of government's lack of adequate investment in new electricity generation, and in maintaining our roads and the other infrastructure in South Africa, your suppliers, farmers, factories, etc., they now have to bear an additional cost. Farmers are now fixing roads because it's cheaper than always replacing your tires and your rims and fixing your trucks to get produce to the market. That increases their costs. So, quite frankly, if interest rates are low, then obviously the cost of capital is also lower. And that could also move us into a direction of higher economic growth. But a large part of the fault with higher inflation in South Africa must be laid at the door of the South African government, which in the last decade has just, not spent remotely enough money on infrastructure maintenance and on new infrastructure. The previous president of this country deliberately halted the renewable energy program of South Africa for 6 years while he was pursuing a nuclear power deal with the Russians. If it hadn't been for that, we would not have load shedding in South Africa today. So inflation is a complex situation in South Africa, and interest rates are not going to bring inflation down. Higher interest rates. That I can guarantee you.
I wish we had more time to go into that last thought in terms of the electricity crisis and where we are now. But just to wind down the conversation, Doc, and so if it is that easy, right, just reduce interest rates, in whose interest is it then that we take this copy and paste model, as you put it, and we apply it to South Africa? Who is it benefiting?
Well, if you have an investment in a what used to be called a money market account, I think the terminology has changed a little bit recently. But if you have a fixed deposit in the bank and they pay you an interest rate which is linked to the prime rate, then certainly you like higher interest rates. But what are the effects on the rest of the economy? So we need to have a broader discussion about interest rates. Currently, five individuals govern the most important economic indicator in this country. We've got 60 million people. And I'm convinced that there are scores of economists and business leaders in South Africa that agree with virtually all that I've said. And it may be time to expand the MPC to also include private sector economists and also to include economists from the Department of Trade, Industry and Competition and from National Treasury. before these decisions get taken by 5 individuals.
Dr. Roelof Botha, Economic Advisor to the Optimum Group, thank you very much for your time this afternoon.